Hi everyone, my name is Sadako Davis and I'm here for our investment analysis presentation for Finance 451 in the fall 2015 semester. So for our project, we were told to choose 2 different industries and then 5 companies within each industry for a total of 10 companies. Then decide, of course, which company do you want to invest in. Choose the best out of the 2 industries, and then between the 2 industries, which one you like the best. So to do this, I decided to compare return on equity, the EVA spread, and any possible dividends. The companies that I chose to compare fell under the industries of mid-tier department stores and then publications and broadcasting. For the mid-tier department stores, I chose Belk, Dillard's, JCPenney, Kohl's, and Macy's. For the publications and broadcasting, I chose Clear Channel Outdoor Holdings, Cumulus Media Inc., iHeartMedia Inc., Lamar, and Liberty Media Corp. So the first topic that we are going to look at is going to be return on equity. As you can see, for most of our companies here, they have positive return on equity, and this is for the mid-tier department stores, so Belk, Dillard's, JCPenney, Kohl's, and Macy's, respectively. As you can see, in 2013 and 2014, JCPenney's had negative return on equity. That is because they had net losses for those years, and then the years before they had very low return on equity. The others were fairly the same year to year, with Macy's having the highest return on equity for the majority of the years. So this immediately, the negative return on equity would take JCPenney's out of the running, in my opinion, because you're not getting any return on your investment. So to further break down ROE, we are going to look at the operating margin and the total asset turnover. Specifically those, because the other parts of ROE are the tax burden, the interest burden, operating margin, asset turnover, and the equity multiplier. The tax burden and the interest burden are governed by the government and the market rates. So you can't really do anything about those. They are what they are. So for our operating margins up here in the top right, you'll see that Kohl's and Macy's have, for the majority of the years, they have the higher operating margin. So they're making more money by selling less. It's because if you look at the total asset turnover, it's the exact opposite. Belk and Dillard's have the higher asset turnover, whereas Kohl's and Macy's have the lower asset turnover. So Kohl's and Macy's are doing well with margins, and Belk and Dillard's are doing well with total asset turnover. As an investor, either one work well as long as they're a higher number. And they seem to offset each other, so all of them seem pretty fair at this point. It just depends on whether you want to make more by selling less, or make less and sell more. So the next topic is economic value added. This is basically the difference between the net operating profit after taxes and the return that shareholders desire. As you can see, it's NOPAT minus the cap charge. You obviously want your net operating profit after taxes to be larger than your capital charge, because the capital charge is what your shareholders are desiring as a return. And as you can see, for all of the 4 remaining companies, they are. Since Belk has the lowest NOPAT, I'm going to take them out of the running. And so now we have Macy's, Kohl's, and Dillard's. So all of the companies paid dividends. However, Kohl's did not pay dividends for the year of 2010 through 2012. So given that information, I decided to Macy's. Macy's had a good return on equity. They had the largest economic value added, and they paid dividends, which will generate income throughout your life. So moving on to the broadcasting and publications. Here we have the Clear Channel, Cumulus, iHeart, Lamar, and Liberty Media. As you can see, the Clear Channel and Lamar had negative return on equity as well for a few years. Cumulus is so small that it barely shows on the sheet. I wanted to note that Lamar has such a high return on equity for the year of 2014 because they had a large tax benefit which increased their net income and reduced their expenses. They also took advantage of claiming a gain on expiring long-term debt early. So that also worked to increase their net income. So that's why there's such a large difference between 2014 and the previous years. So once again, what makes up ROE? For these companies, since they're mainly subscription and service companies, they didn't really have very high asset turnovers. They were very, very small numbers. So here I'm just going to focus on the operating margins. As you can see, in 2012, LMCA had a negative margin, which is not a good thing. Overall, it looks like Lamar has the higher number, and iHeart is pretty steady across the board. So now to look at economic value added, just the same as the difference between operating profit and their desired return to shareholders. So, so far we've taken out two companies, the Clear Channel and Liberty Media. So we're left with Cumulus, iHeart, and Lamar. As you can see, Lamar has a negative EVA spread because their cap charge is much higher than their operating profit, which is not the way that you want to go. You want to go in the middle, iHeart, who has more operating profit than they have capital charge. Cumula Media also has less operating profit than they had cap charge. So due to that, I would choose iHeartMedia. They had a good, steady return on equity. They had the largest economic value added. Their operating profit of ROE was pretty steady. Unfortunately, none of the three final companies have steadily paid dividends. So that really wasn't a deciding factor for this market. So I just went off of ROE and economic value added. So between the two, being Macy's and iHeartMedia, you can see that Macy's has a much, much higher return on equity, and it is increasing as the years go by. So they're doing a lot better than iHeartMedia, which seems to be a little bit of decreasing over time. Operating margins, as I said earlier, iHeartMedia is a service provider, so they don't have a whole lot of asset turnover. But if you look at the chart here, you see that iHeartMedia's operating margin is higher than Macy's. And that's only because Macy's is able to turn over a lot more product, so they can operate on lower margins, whereas iHeartMedia has to have a higher margin to make up for the fact that they don't have any really assets to turn over. They're strictly services. So to look at economic value added, it's the difference between the operating profit and return to shareholders, as we said a few times now. Both of them have positive returns. Pretty even spreads as well. Macy's, however, has more capital charge, so they're able to do more. That's why their side is higher, because they have more leverage, so they're able to do more with that. But if you look, the spreads between the two are pretty even. So, between all of my companies, I would decide to go with Macy's. They had the best return on equity, they had the largest economic value added, and they pay dividends. So you'll have a cash flow stream for income. So thank you very much for watching. I hope you have a great day, and good luck with finals.